Welcome to the fourth chapter of fixed income securities. Very important, asset backed securities. Why is it important? Because again, this is there in level 2 and level 3 with greater difficulty in level 2 and 3. So, the concepts that we do over here right now in level 1 is very important. No doubt, this particular chapter is simple, but for that you need to first understand it well. So, no memorizing and no by hearting stuffs, only and only understanding the concepts. That is what is going to help you in examination. Okay, so let's start with the subject. What are we going to do in this chapter? Well, the first one, we will be understanding the securitization process. Then we will be doing classification of the securities, okay, asset backed securities based on the collateral. Then prepayment and prepayment risk, very important. Then knowing the collateralized mortgage obligation, what CMOs are, okay, so this is the CMO, collateralized mortgage obligation. Then knowing something more about commercial mortgage backed securities and other asset backed securities. Okay, all of this relates to asset backed securities. Many of you all at your workplace maybe would be knowing what asset backed securities are, but even if you don't know, no worries. By the end of this chapter, you would be completely aware of what asset backed securities are. Okay, let us move on to the next one. Securitization. What is this securitization? What do you mean by the securitization process? So, securitization is a process by which financial assets, example mortgages, car loans, etc. Okay, so a process by which these financial assets are purchased by an entity that then issues securities supported by the cash flows from those financial assets. Okay, a very simple example I am going to tell you. Okay, there is a bank in India. The bank is known as Hdfc Bank Limited. Okay, this bank in India has various branches throughout the country. A country having more than 1.3 billion people, right? So, various branches throughout the country. Now, through these branches, there are various home loans given to the borrowers. Okay, there are many people in this country, so many people come for home loans, and therefore this bank is in the business of giving home loans. Now, Hdfc Bank Limited gives money to the borrowers, and those borrowers then buy the house or a property, and that property is actually mortgaged in the name of Hdfc Bank Limited, so that in future, if in case those borrowers don't pay back the money, then Hdfc Bank Limited then catch their heels, okay, and they can sell the property and take back their money. In case any extra money is left, they will throw on the face of the borrower, but they will recover the whole money by selling the property. This is what is the business of Hdfc Bank Limited. So, what has Hdfc Bank Limited done? So many businesses, of which one business is giving home loans, and therefore Hdfc Bank Limited has given out loans to different people in the month of October. In the month of October, Hdfc Bank Limited has given various home loans to various people. Okay, too many people. In 1 month itself, it has given home loans to many people. So, there are many loan borrowers to whom Hdfc Bank Limited has given. Okay, these are homes. I hope you all understand what this is, right? So, in our school days, we would have done such type of homes, right? This is what the home is going to be, correct? Well, so this is what the home is. So, various home loans are given to people around the world in the country. Okay. Now, in the month of October, just as an example, in the month of October, Hdfc Bank Limited has given loan worth $100 million. Okay, loans worth $100 million is given by Hdfc Bank Limited to different loan borrowers. Okay, home loan borrowers or borrowers. Now, October month has just got finished. In the month of November, again HDFC Limited has many branches and people are going to come for inquiry, and accordingly HDFC Bank Limited is definitely going to give more loans in the month of November as well, in the month of December as well, and as and when month goes by, it is going to keep on doing business. Okay, it is going to keep on giving more and more loans, and going by the name and being such a big bank and a very progressive bank, what is going to happen? The business is going to increase. If say for example I have given good loan, HDFC Bank Limited has given loan worth $100 million in this month, maybe next month it will do more business, then more and so on, it will go on to $200 million worth of loans to in the month of maybe next year, the 1 month, then maybe the few more months later it will increase to $300 million a month. Where will all the money come from? So what is HDFC Bank Limited going to do? This bank is going to create on 1st November, okay, all the loans that has been dispensed in the month of October worth $100 million, every day little loans would have been given out. In the month of November, 1st of November, HDFC Bank is going to create a special purpose vehicle, okay, they will be creating a special purpose vehicle or a special purpose entity, okay. This special purpose vehicle or known as special purpose entity, it is going to create specifically only in the books or only on the record perspective, okay, only for the record perspective, it is going to create a separate legal entity known as a special purpose vehicle or a special purpose entity. Then what is it going to do? It is going to transfer all of these home loans in the name of this particular entity. Okay, it is going to transfer all the home loans in the name of this particular entity. It will be now seen as if that SPV has given loan to so many of these people, not HDFC Bank, okay. All the loans would have been transferred in the name of SPV or special purpose entity. Till this date, till October, all the loans that were given earlier, that was an asset of HDFC Bank Limited. In future, HDFC Bank was going to get EMIs, okay. EMIs are what? Equitated monthly installments. So monthly installments from all the loan borrowers was going to come to whom? To HDFC Bank Limited, and therefore whatever the loan is given in the month of October, that becomes an asset for HDFC Bank Limited, which later on every month HDFC is going to collect from that asset money. They are going to collect money from the asset that has been created, correct? Now this asset itself is transferred to a special purpose entity or a special purpose vehicle. Now it is seen on 1st of November, when everything has been transferred to a special purpose vehicle, the SPV or SPE is going to be seen as if they have given out loan to different loan borrowers, okay, home loan buyers or home loan borrowers. Now what is going to happen? This SPV is going to issue securities to investors in the market. So there are various small investors in the market, okay, small investors like us, okay, who has $1,000, $10,000, $50,000, okay, $100,000, okay, this much is the money that I have for investments, okay, people are having in the market. So many small investors are having so much money in the market, okay, all of them. This particular SPV is going to issue bonds, okay, this particular entity is going to issue bonds to these investors in the market, and in return these investors are going to give money to the SPV because bonds have been issued. So SPV will issue the bonds to the investors and investors will give money to the SPV, correct? Now these bonds which have been issued to the investors in the market, they are actually backed by the cash flows that they have been receiving from these loan borrowers. Loan borrowers will give on a monthly basis certain installments, it will now give to SPV. That installments will then be given to whom? To the investors. So, if say for example, I am a small investor, I have invested in this particular bond $1,000, then every month I will be getting $10 for next 10 years maybe, just as an example. So, whatever the cash flows are received from these EMIs, okay, that amount is going to then reach to whom? That EMIs on a monthly basis will reach to the SPV. SPV will not keep that money with them, and that SPV will give it out to these investors on a proportionate basis. Correct? This is what is the securitization process. Okay. First day when the bonds were issued to these investors, on the first day when the bonds were issued to these small investors, SPV got the amount. SPV got $100 million. That $100 million SPV gave this to the Hdfc Bank Limited on 1st of November itself. So, what did Hdfc Bank did? Hdfc Bank issued so many home loans in the month of October. As soon as the month of October got completed, on 1st of November, Hdfc Bank created a special purpose vehicle. That special purpose vehicle is only a special purpose entity which is made in the books of accounts. Okay, you are not going to find any building or a property outside. That is just made in the books of accounts. So that Hdfc Bank Limited just transferred all the assets in the name of special purpose vehicle. Now it is seen as if that special purpose vehicle has given out loan to the home loan borrowers. Same day, SPV has given out or issued bonds to the people in the market. Okay, various investors in the market. SPV has issued $100 million worth of bonds in the market to the investors, and the SPV has told the investors that in future whatever the amount they receive from the EMIs, that is the installments from these loan borrowers, in future every month it is going to flow to the investors. The money will come to the SPV, SPV will give all of them to the investors, and therefore investors subscribed to these bonds worth $100 million. SPV took that $100 million and paid off to Hdfc Bank Limited, which means Hdfc Bank got all its money back just in 1 month. Like in October they packaged all the home loans together, right? So all the home loans they packaged together and just transferred it to SPV, and the SPV same day gave $100 million back to Hdfc Bank Limited. Now Hdfc Bank Limited is free. It has got its money back, its capital is not getting stuck, okay, and Hdfc Bank Limited can freshly start its new business. It will start its new business fresh again from next month. In the month of November again it is going to disburse $100 million worth of home loans, okay, whatever the business is, how much ever business it gets, it is going to disburse these many loans. Over here what is going to happen with the SPV? This SPV is then going to, this SPV who has given home loans to these borrowers, every month, in the month of November, in the month of December, in the month of January, in the month of Feb, March, April, May, it is going to keep on getting some amount of principal and interest payments back, which is known as EMI in our normal language. Okay, in our general language this is called as EMI. Every month these home borrowers, from their salary they are going to pay back the EMI to the SPV, and this SPV is not going to keep even a single money with itself. Its work is just to transfer the money back to the investors over here, because investors had subscribed to the bonds earlier, only then they gave $100 million, right? All the money is then going to go to the investors. So technically speaking, it is the investors who have funded this home loan borrowers, and then whatever but through whom? Through this SPV. HDFC was just the originator of the loans. They showed their capability of doing the business, nothing else. Ideally it is these investors who have funded the home loan borrowers. and therefore every month these home loan borrowers are going to pay EMI to SPV, and that SPV is going to pay to whom? To the investors. This process of transferring, okay, this process in which the financial assets are purchased, okay, it is purchased by an entity which is SPV, by an entity, which entity? SPV, that then issues securities over here which are supported by cash flows from these financial assets, correct, which are supported by the cash flows from these financial assets. So the cash flows, where is this security going to get money from? Is the money going to grow on the tree? No. Where is this security going to get money from? The security will get money from these financial assets, and then that is going to go to the investors. This process is known as securitization. Every financial company has done this process in its life. They would have done it. And securitization process is a must if HDFC Bank Limited wants to transfer the money or get the money. If HDFC Bank Limited wants to grow in life, okay, then this process needs to be done. Otherwise, all its capital is going to get stuck in these activities only. Okay. Okay, what is the, tell me one thing, what is the balance sheet of a bank? Okay, if at all we are following a T-shaped balance sheet, what will be the balance sheet of a bank be? On the asset sides, there will be so many loans given out, home loans, car loans, and gold loans, and what not loans, okay, all the types of loans will be given out over here. Where will the money come from? Will there be equity? Completely all 100% equity? If this is 50, this is 40 and this is 10, all 100 will be equity? No, there will be deposits, there will be other liabilities, there will be other borrowings, right? Where is all the money coming from? 90% of the money would be coming out from here, and only 10% will be equity. Like that is what the capital adequacy ratio and all means, right? So this will be less, this will be more, and this is what the bank is doing. The bank is going to lend out money. The bank's business is to do the business. What are its branches going to do? The branches are there to do the disbursements of the loan, right? So capital constraint should not be there, and therefore the bank is going to transfer everything to the SPV. No doubt it will keep a couple of percentage points or something for them. They will be taking the service fee, you know, all of these things. So what is going to happen is HDFC Bank Limited, who is transferring it to the SPV, okay, and then there will be home loan borrowers, and then there will be different investors, okay, small investors. Now there are three major parties involved over here. The first party is the originator. Originator means the one who has originated the loans, okay. So this is the originator, they have originated the loans, and therefore he is known as the originator. Over here HDFC Bank Limited has originated the loans. In front of the public, these home loan borrowers, actually they don't know what the SPV process is, okay. They don't know, they only know what HDFC Bank is. They have taken loan from that particular branch. So home loan borrowers, if they have any kind of complaint, any time of activity, you know, in future, anything, if they want to connect with them, they will go to the branch of this bank only, correct. They don't know that behind bank has transferred everything to an SPV, and behind that also the investors have actually given money and what securities have been there. They don't know what bank has done behind in the month of November. They are just concerned with their loan and they got it. So in the month of October, they got it from this particular branch, XYZ branch, from the Mumbai branch. They just know that much. Now they don't know that behind on 1st of November, my loan was packaged in along with all the other home loans of October month, and in the October on 1st of November this was packaged and they were actually transferred to an SPV, and that SPV has issued some securities to investors over here. These home loan borrowers don't know all of these things, right? And therefore what happens is that there are two parts. One is an originator And the third one that we will be seeing is the servicer. We will go to the servicer as a component. Let us see later on. SPV is another vehicle. This is special purpose vehicle or a special purpose entity. And now this SPV actually is known as a bankruptcy remote vehicle. Remember this word, bankruptcy remote vehicle. This SPV is a bankruptcy remote vehicle with a great, there is a huge unfortunate event, okay, like the subprime crisis. We will see that later on, okay. Subprime crisis, I will explain you very well. It is a classic example, once in a lifetime learning that all of them had it. Many of you all would be very small at that point of time, okay, very young, but even if you don't know, today I will tell you what subprime crisis was, but we will see that later on. Right now just holistically understand what it is. I use the word that SPV is a bankruptcy remote vehicle, means SPV is never going to become bankrupt. It is a bankruptcy remote vehicle, which means, say for example, you highly unfortunate and it will not happen, okay, but let me just give a hypothetical example so that it directly goes into your mind. Say for example, all the loan borrowers, okay, all of them from the month of February 2022, they stopped paying the EMIs. I don't know what happened. There was a huge, maybe a war happened, or maybe huge financial crisis, and each and everyone stopped paying the EMIs. Okay, something happened. Okay, God knows what happened, but something happens. It should not happen, but then just as an example, something happened, and all of them stopped paying EMIs. You know who will be at a loss? These investors will be at a loss. HDFC Bank is not going to be at a loss. This SPV also is not going to be at any loss, because the securities that are issued over here, they are supported by cash flows from these financial assets. Only if these financial assets are going to pay the money, then investors are going to get it. If they stop paying money, then the investors are not going to get any money. Correct? Then the investors are not going to get any money. And therefore we say that SPV is a bankruptcy remote vehicle. These investors cannot come to the SPV and say that now if they are not paying, then you will have to pay the money. Where will SPV bring money from? SPV doesn't have any money, and anyways SPV is just a vehicle that is created in books of accounts, in just the records. You cannot find an office anywhere, and neither can these guys, investors, go to the HDFC Bank Limited, because their contract is with this SPV, and SPV has given out this security over here, a bond, and on the bond the covenants are written down, the terms and conditions, right? Covenants in the bond indenture, we have learnt the covenants, it is written down that it is supported by cash flows from these home loan borrowers. Now if these home loan borrowers don't pay money, then SPV is not responsible or liable to pay any amount to investors. It is the investors who will have to take the loss. Correct? Well, if these home loan borrowers very happily pay all the EMI, then SPV will transfer all the money to the investors. SPV is not going to keep anything with itself. SPV's work is just to take money from one side and just pay to the other side. Take the money from one side, pay to the other side. Take the money from one side, pay to the other side. SPV is just going to transfer. It doesn't have any particular act or any particular activity to be done in between. Its work is only to transfer, and therefore it is a bankruptcy remote vehicle. It will neither ever become bankrupt nor it will ever take any profits. It doesn't have any particular thing. So originator is one of the component. So this HDFC Bank is the originator. SPV is another component, and the third component is the servicer. Servicer means the one who will be giving all the services throughout the period. Okay, say for example, I have someone has taken a loan. Okay, someone has taken a loan and he had taken the loan from Mumbai branch of HDFC Bank Limited. If he has taken loan from Mumbai branch of HDFC Bank Limited, obviously in future, if there are at all there are any complaints, there is he wants to close the loan, or he wants to give any money, he wants to give cash, or he wants to deposit the check, or anything. Where will he go? He will go to Mumbai branch of HDFC Bank Limited, right? And therefore, this particular case, HDFC Bank Limited's employees are going to help that person. They are going to take the complaints of this particular person. HDFC Bank Limited's call center will be utilized for this particular thing. HDFC Bank Limited will send SMS and intimations of deduction of EMIs or any of the installments to these particular home loan borrowers on a monthly basis. Okay, they will be sending the reminders. So all the services given by whom? The infrastructure is set up by HDFC Bank Limited. So HDFC Bank Limited is going to give these services to home loan borrowers, and therefore servicer is again in most of the cases HDFC Bank Limited only. In few cases maybe some other person or third party would be contacted or contracted to give the service, otherwise it will be HDFC Bank Limited only as the servicer. No doubt it will be charging some minimal fee, like out of $100 million every month, like hardly few $1,000, like $15,000-$20,000 will be the fee or something that will be charged, right? So that is a very minimal fee out of whatever the money they get from here, that hardly some amount will be taken by HDFC Bank Limited, right? Again, there is lot of scribbling, but I have explained you quite a lot of time what securitization process is. Let me again read this whole form definition: a process by which financial assets, example mortgage, car loans, etc., are purchased by an entity which then issues securities supported by cash flows. These securities which are supported by cash flows from those financial assets, right? So these securities are therefore called as asset backed securities, because what is the backing of these securities? The backing of these securities is these assets. These assets are backing these securities. In future, the money that comes from these installments are going to be reaching the investors. In case they stop paying all the money, then investors are going to face all the losses. Okay, investors will be facing all the losses. This is what SPV, a bankruptcy remote vehicle, is. Fine. I hope you all have understood the securitization process. Very, very important. Okay, let us move to the next topic. Okay, what are the economic benefits of securitization? Let us understand economic benefits of security. Why would an originator like to do all of these things? Okay, he can keep it in his balance sheet. Why is he doing all of these things? Moving it out to a special purpose vehicle, and then everything happening from there. Why is he doing it? Okay, what are the economic benefits of securitization to the investor? Why would investor like to invest in such securities? Rather, it could have done one thing. It could have directly given money to the HDFC Bank Limited, right? Investor would have invested directly in HDFC Bank Limited. It would have given loan to HDFC Bank Limited. Why did they invest only in this particular security whose cash flows are so much dependent on just this particular asset? If at all they would have given money to bank, HDFC Bank Limited, and if these people don't pay money, but if they would have given it to bank directly, then what? The loss would be in the books of banks, and now banks would have figured out if any of its other businesses would have done lot of profit, then this investor would have got money from there as well. Then what is the reason for coming up with this securitization process for the originator and for the investor to invest in those securities only? We will just list down. It is very simple benefits, and I am sure you would already be knowing many of them. So from the originator's point of view, we say first thing, liquidity management. The originator is receiving funds immediately. The originator gets the fund. On the 1st October to 31st of October, every day home loans have been disbursed to the people in the market, HDFC Bank Limited. And on 1st November, all the home loans, okay, say for example 500 loans have been disbursed. All the 500 loans are packaged in one packet and then that whole packet is transferred to, of all the 500 loans are transferred to the SPV. The SPV on 1st November is then going to issue securities in the market. Various investors are going to invest in those securities, and whatever the money SPV gets on 1st of November, SPV is going to transfer everything to HDFC Bank Limited. Now this is what happens. So what is the first point? The first point says HDFC Bank got its liquidity back. Who doesn't like liquidity? Everyone likes liquidity. We saw during COVID period, everyone wants liquidity in their hands, right? So therefore, liquidity is required. We saw during IL&FS, DHFL case, what happened? Liquidity was crunched in the market. People want liquidity. So this is how everyone wants liquidity, and this is how you can create liquidity, right? So whenever you are in dire need of liquidity, what will you do? Just packet your good loans, okay, all the similar loans, okay. You cannot packet few home loans, few car loans and few gold loans and all of those loans together, packet them in one packet and then sell it out to SPV. No, that's not possible. All the home loans together, one packet of that. Okay, if you still want to create an SPV, create another SPV for all the gold loans together. If you still want to have car loans, create another SPV for car loans packet. Okay, that is allowed, but you cannot package everything in one packet only. Okay, so the first thing is you receive the funds. The originator receives the funds immediately on 1st of November. It has all the $100 million funds with itself. So that is one thing. The second thing is it improves all the ratios. Okay, so all the ratios have also been improved. If on the balance sheet there were lot of assets and in the P&L there is some income, say for example there is $10 million income. Now $10 million, if I want to calculate what is the ROA, return on asset, okay, what is the ROA of this particular bank? So I will say return divided by average assets. Let us take assets for the time being, divide by assets. Now if you do not package this into a new loan and give it out in the market, okay, you give it out to investors, then they are going to remain in your balance sheet itself. Now return is going to remain the same, the profitability of the company is going to remain the same anyways, but the assets are going to increase, right, because they are in the books of accounts, they are not transferred to a third entity and cash is not taken back, it is not taken back. So assets are going to remain in your books. If the assets are going to remain in your book, then what is going to happen is your returns, the return on assets, see over here the denominator is increasing, assets are high and therefore your ROA is going to be lower. If your ROA is going to be lower, you will be moving slow in your life, your share price is determined by the ROA that the company is generating, the ROE that the company is generating and so on, right, and therefore it improves the ratios if you remove the assets from your balance sheet. When you remove the assets from the balance sheet, your denominator decreases, and once your denominator decreases, your return on assets are going to increase, right. This is your second point. The third point, risk management, credit or default risk is significantly removed. When the creditor, now if say for example I said if the home loan borrowers are not paying the money, whose credit risk is removed? The bank's, HDFC Bank Limited's credit risk is removed. Now in case those home loan borrowers are not paying the money, then investors are going to face the loss. It is the investors who will be facing the loss, because SPV's work is only to transfer the money to the investors. If SPV is not getting any money, then it is actually whom? It is actually the investors who are going to face the losses. HDFC Bank Limited on 1st November has got all its $100 million back, correct. So that is one of the main, like this is a very important thing, like very important benefit. This is also a major important benefit, okay, actually even this is a benefit, and there is reduction in funding cost as well. Well, the funding costs are also less because you have got back the money and you can do the business with the same $100 million, right. So that is another thing. Now what are the benefits for the investors? Let me see, okay. How can you have a win-win situation for everyone? This is what is showing. There are benefits for investors as well, and therefore this is a win-win situation. It is a win-win situation for the originator as well as win situation for the investor as well. So how is it important? Let me just see. Smaller ticket size investment is possible. Now come on, you tell me, if you want to give a home loan to someone, there are so many risks. The first risk is you will have to give, say for example, a home in even in Mumbai the prices are quite high. In India the prices in Mumbai are highest. Consider a home worth $1 million. Okay, it is a $1 million home in Mumbai over here. Now what is going to happen if I want to give loan to someone? Can I give, I have $10,000 with me, take $10,000 and purchase a home. Can he buy a home worth $10,000? That's so less, right? He cannot buy a loan. Okay, even if I have $50,000, he will have to compromise, he will have to take a smaller home, right? And therefore I will have to give full $100 million to that other person to buy a loan, to buy a home, correct? And therefore we say that in case I have little bit of money and if I want to invest that little bit of money in home loans, okay, if I want to give my money in home loans so that I receive interest from that, coupon and principal back, then lower investment or small ticket size investment is also possible. You just purchase one bond worth $1,000, par value of one bond is $1,000 only. So it will be as if you have given or contributed $1,000 only out of $100 million pool that was having, correct? So that is one benefit. Smaller ticket size investment is possible. If you want to give outright loan to someone else, you would have to give full $1 million. But now what is going to happen is you can even purchase one bond worth $1,000 only. Like me or like you, there will be 10,000 other people who will be paying $1,000 each, and then 100 million will be done. That will be pooled, right? So smaller ticket size investment is possible. Trading is also possible. If you have given loan to someone and if after 3 months you feel that you want back your money, someone is not feeling well at your home, there is too much of hospital expenditure happening, or you need money, whatever be the reason, you cannot immediately go and tell your friend that okay, give me the money back, I want my money back. What will he do? He will sell his home. That is not possible. But if you have invested in these securities, asset-backed securities, you can go in the market anytime and sell those bonds to someone else. Just the investor hand is going to change. This is known as secondary market. Directly go and sell your bonds to someone else. You will get back your money. And the third one, better ratings due to specific identification of type of investment. So you get a good rating also. Okay, you get a good rating. Remember over here the risk is severely diversified. If I give a loan to my friend to buy a home, and God forbids if anything happens to his job or anything, he is not able to pay back the money to me, then all my money is gone. Obviously I will sell that home, but if the home prices have fallen down, then during subprime crisis it happened the same thing. Home prices fall down like anything. I went and sold the home, but then I got only half the money because the prices of home had fallen down. And therefore over here in securitization process there is a lot of diversification. Home loan is given to 100 people. Now out of 100 people, if 1 or 2 are not paying back due to whatever difficulty they would have had, okay, they would have be seeing the worst of their time, okay, they would have lost their jobs, they would have made massive losses in business, whatever due to any reason. If they are not paying, out of 100 people, if 1 or 2 are not paying back, then at least 98% people are paying their money properly, and therefore my whole $1,000 that I have invested in one bond, that is not going away. Maybe out of $1,000, $10 or $20 is the loss that I will be facing, right? And that too, that person would have at least paid half the installments. Out of 10 years, maybe he would have paid at least for 3-4 years. So technically my losses are going to be significantly reduced, correct? These are the different benefits that the investors are also having. So this is the small update of what securitization as a process is. So understand it's a very important process, and so many companies, okay, so many, I would rather say there are very few companies who wouldn't have done in their whole history of their business a securitization process. All the companies would have technically done it, especially during bad times. These companies come up with securitization process and they would try to, when they are into liquidity crunch, what will they have to do? They will have to sell the assets from their balance sheet because they don't have money, they want liquidity in their hands. So they are going to just package few of the good loans and they are going to transfer it to the SPV, and that SPV will then obviously SPV will also have to, SPV is nothing but HDFC Bank Limited's baby only. Till the time they don't find the investors in the market, it is HDFC Bank Limited's baby only. So SPV is then going to find out in the market different investors who wants to invest in these particular assets. Obviously HDFC Bank Limited is going to choose or pick up only the best of the assets and then package them and then transfer it to the SPV so that they get investors in the market. Okay. So in the times of liquidity crunch, this process happens. This is known as securitization process. Now coming to classification based on collateral. Remember I told you there is this SPV. Now there is this SPV. SPV has given home loans or car loans or gold loans or whatever types of loans. Okay. This SPV has given home loans, and in return SPV has issued so many bonds or securities to people in the market. Correct. Now these securities are issued to many investors. Now these securities we are calling it as asset backed securities. Why? Because these are backed by some assets over here. This is the asset. Okay. If these are not paying money, then they will face loss. Ideally means these homes will be sold out in the market, and accordingly whatever the proceeds are coming from by selling these homes or houses, it will go to these investors then. Correct. Now these securities are therefore called as asset backed securities. Now we are going to give naming or naming nomenclature of this particular asset backed securities are based on the assets that are over here. If these are home loans, then they will be called residential mortgage backed securities. If these are gold loans, then they will be called as asset backed securities. So what will be the name of this particular security will be dependent on what is the collateral asset over here. This is what we are going to see. So classification is based on the collateral that has been kept. So if say for example the collateral is a property, okay, it can be any property, residential or commercial, whatever. If it is a property, then the securities that have been issued, those securities will be called as mortgage backed securities. So if I come and tell you that listen, I have invested in few mortgage backed securities, then you will immediately come to know in your mind that okay, there is a securitization process that has happened, and then in that securitization process whatever the securities have been issued, those securities in which I have invested my money, okay, the collateral behind those securities are nothing but a property. Then you will ask me a question that okay Aadit, what kind of mortgage backed securities you have invested into? Then I will either say residential or commercial. So residential mortgage backed security means the property that is the collateral is a residential property. If it is a commercial backed securities, okay, commercial mortgage backed securities, then the collateral that has been kept is nothing but a commercial property. This is what the residential and commercial mortgage backed securities are. I hope you all are understanding. I'll move further down to residential mortgage backed securities. There are two types of residential mortgage backed securities: agency and non-agency residential mortgage backed securities. Agency residential mortgage backed securities means what? In the US, we are doing US CFA, right? So we will be learning more about the US. In the US, there are three companies: Ginnie Mae, Fannie Mae and Freddie Mac. Okay, these are government backed organizations. Okay, so like in India there is LIC. Okay, it is not the government, but it is backed by the government. Okay, if anything happens to LIC, it is technically government will be taking over LIC, and whatever the dues are there, it will finish it off. Okay, the government will take over. LIC will never go bankrupt. This is how we are trying to say. In US there is Ginnie Mae, Fannie Mae, Freddie Mac. They are backed by the government. Okay, but they are not governmental organization. So these three companies, Ginnie Mae, Fannie Mae, Freddie Mac, if they are issuing loans, okay, if they are issuing loans and they are issuing the securities on the other hand, then those securities which are issued by these three companies, Ginnie Mae, Fannie Mae, Freddie Mac, then they will be called as agency mortgage backed securities. Agency residential mortgage backed securities. Why? Because they have been issued by whom? By these three companies. What are non-agency residential mortgage backed securities? If, say for example, Citibank or JP Morgan or Morgan Stanley or Wells Fargo or any Bank of America or any of these companies, okay, which are not those three companies. If any of these companies have given out loan in the market, home loans in the market, and then in the next month they have created an SPV, and then SPV of these companies have then issued securities to different investors in the market, then those securities will be called as non-agency residential mortgage backed securities. They are called as non-agency residential mortgage backed securities. And these non-agency residential mortgage backed securities are riskier in nature because firstly, the loans that these people would have given would be on a lesser stricter terms, like these agencies would have given, these three companies, agency residential mortgage backed securities, they would have given loans on a stricter basis, like lower loan to value ratio, or when a few more documents are there, the credit quality of the loan borrower is little bit stronger. At that point of time, agency residential mortgage backed securities would have been given. But over here, what would have been happen? They would have given on a lenient terms and conditions as well. The way Lehman Brothers had given loan on a very lenient basis to so many people. Any Tom, Dick and Harry would come and take loan from Lehman Brothers and they would have given out the loan. Okay, which means with a minimal, with a most lenient way. Okay, I would not say strict at all. In a very lenient way, disbursements were done for home loans. Okay, so these are non-agency residential mortgage backed securities. If I tell you I have some non-agency residential mortgage backed securities, and if the market conditions are very bad, okay, economic condition is very bad, then actually I need to worry because it is non-agency residential mortgage backed security. Correct? Now these are the mortgage backed securities bifurcation. Next, moving on to asset backed securities. What happens in asset backed securities is there are various types of asset backed securities. Like no doubt the top is also known as asset backed securities, but when you bifurcate further, it is mortgage backed securities and asset backed securities. So it depends which type of asset backed securities you are talking about. If it is this asset backed securities, then there are different types again within this asset backed securities. If the securities that are given out over here are backed by automobiles, okay, this is an automobile, okay, the car, or let me do this kind of a car, right, this is the car, okay, the asset over here is the car, and if the loans are given out to different automobile loans are given out and investors have been issued these securities, then these securities will be named as automobile backed securities. If there are credit cards over here, what happens in credit card? You are swiping the credit card, right? Every month you swipe the credit card, but the payment you make is after 1 month. So if on 31st of December or on 30th of November or on 31st of October, when the balance sheet gets closed, at that point of time you are an asset for the organization, for the bank, because you have swiped but not yet paid money, and therefore you are an asset in the books of bank. Now what will bank do? Bank will package these assets and sell it out to the SPV. So over here, who are the collateral? Credit card receivables, they are the collaterals. So against that, if these securities have been issued, then they will be named as credit card receivables backed securities. Then likewise, collateralized debt obligations are there, collateralized bond obligation. If bonds have been kept as a security and with the bank, and bank then transfers it to the SPV, and SPV then issues securities in front of these bonds as the collateral, then the name of these securities will be collateralized bond obligation. Same way, collateralized loan obligation, structured finance CDOs, all of which we will be seeing later on in the chapter. Okay, but this is the important point that I want to make, that the naming of this particular security will be based on the collateral that has been kept over here. Fine, we will move ahead. Well, Now coming to amortizing, fully amortizing level payments. Remember when we were in chapter 1, we had done fully amortizing and partially amortizing loans, when we were doing bond repayment structure, how the principal is getting paid back at that point of time. There was one bullet structure and amortizing structure. Within amortizing structure, what were we doing? Within amortizing structure, we further divided into fully amortizing and partially amortizing, right? This is what we are looking out over here. Fully amortizing level payments. Now, you know what is the basic general in our language, in our day-to-day language, what do we tell this as? You will immediately understand. EMI, equated monthly installments. This is nothing but your fully amortizing level payments. But if you use these words in board meetings, like this is a fully amortizing level payment, then people will think, wow, few of them will not understand, and only the few of them who understand will feel, wow, he has such a nice knowledge about the finance, right? So this is what your fully amortizing level payments are. Now, what are fully amortizing level payments? Fully amortizing level payments means the equated monthly installment, and in equated monthly installments, what do we mean? Fully amortizing means the whole, say for example $10,000 loan is given out and every month $100 is paid out, okay, $100 is paid out, then 100 is paid out. The balance, whatever it is, okay, the first time the balance will be this much, the second time balance will be this much, then it goes on, in last the balance will be 200, 100 is paid out, 100, another 100 is paid out, and then it becomes 0 when the last 100 is paid out. This is known as fully amortizing. Amortizing means every month principal as well as interest component is paid back, which means your loan outstanding keeps on decreasing every month. In a bullet structure, it doesn't happen like that. Only in a bullet structure, only the interest is kept on paid back, and in the end, in the last day, the whole principal amount will be paid. But in an amortizing loan, what happens is the principal amount is also paid back little, whatever, it can be same amount or a different amount, whatever, that we'll see later on. And fully means what? Fully means that in the end, 0 amount is left by paying the same. You don't have to pay 20,100 because there was 20,000 loan that was pending on the last day. It doesn't mean like that, correct? So this is fully amortizing, and level payments means every month you are paying the same amount. The same thing is what is your EMI, equated monthly installments, that you pay, right? So this is known as EMI, fully amortizing level payments. Now going to the next one, recourse loan and a non-recourse loan. Now what are these two words? Recourse loan and a non-recourse loan. Recourse loan means you have some option left with you, okay, you have some recourse to go back, you have something left with you. Recourse, there are some options still available. As a last resort, something is still available, we call this as recourse loan. A non-recourse loan means non-recourse, no option left with you now, no option left with you. See, non-recourse, no option left with you. Your hands are tied, you cannot do anything. The only option that was given to you, only that is available. Over and above that, no option is left with you. Non-recourse loan. Now in US, technically there are two types of loan. In US there is only a non-recourse loan. Now what do you mean by both of them, so that you can understand that why in US there is only non-recourse loan and we don't have recourse loan over there in US, okay? But I'll explain you both of them, a recourse loan and a non-recourse loan. Let me explain you. Now what happens in a recourse loan is that if, say for example, I am having lot of money, I am a bank, say for example, okay, I am giving home loan to someone. Say for example, I gave a home loan to, shall I take my example only? My example in the sense my name, okay, I have not done all of these things that I am going to speak, because I will be speaking that I go bankrupt and all of these things. So nothing has happened with me fortunately till now, touch wood, but then I want, oh, okay, let me not take my name only. Let me not take my name. I don't want any thing to happen with me, okay. So let me take example of XYZ. Okay, so I am a bank and XYZ has taken a loan from me on a recourse basis. Okay, recourse loan, it is a normal recourse loan. Now say for example he took a loan worth 100 million, no, 100 is too much. He took a loan worth $10,000. The house is worth $10,000. It's quite less, I know. Nowhere, only in the villages maybe you may have a home, shabby home worth $10,000. I don't know what it is in US, but okay, considering that $10,000 is worth home and that XYZ came to me, he took a loan from me worth $10,000, okay, worth of loan from me. Now after few months he is unable to pay the money to me. So what do I do as a bank? I will take the home keys from him, throw him out of the house, and then after few months or immediately I am going to put that home on auction. When I put the home on auction, he had just paid $1,000 out of it, $9,000 was still pending to be taken. Now what do? I auction the home and I get only $8,000. I tried my level best, okay, but the home prices had fallen down and out of the best thing I got only $8,000. Now if it is a recourse home, I can go to this person XYZ home, okay, wherever his another home would be there, he would be staying somewhere with his parents or with his friends or somewhere, wherever he would be staying. I would go to his home, whatever clothes, earrings, ring, whatever else that he is having, I will just snatch that away from him. Okay, this doesn't happen in reality. Okay, I am just giving you a very hypothetical example. Don't quote me anywhere in wherever in court of law, anywhere that I have been teaching like this. This is just an example. Okay, so recourse means I have some option left. I will go to him, I will take away his mobile phone, right? That will be worth 100, 200, not even 100, $500, right? That will be worth $500. Then not even $500, maybe $100, whatever, but I will take back his loan, I will take his mobile phone, I will take his ring, I will take his clothes, whatever he is having. What else will I do? This is the only option that I have. So I am going, if this is a recourse loan, I can recover the 1,000 shortfall that I am having. By selling the home I could get $8,000 and still he was left to pay $1,000. I am going to somehow go to him and take back $1,000 to him. This is what your recourse loan is. Even after selling the home, I was having some still options left to go to him, take his mobile phone, take his ring, take his earrings, take his gold chain, everything, take his watch, whatever he is having, and then recover my money back. This is your recourse loan. If this was a non-recourse loan, it means only that there is no other option left with you, and therefore what you can do is non-recourse. What you can do is, if you sell the home at $8,000 and you had to take $9,000, you have lost $1,000. You in your life you will not get back this $1,000 because now you don't have any other option left with you. Okay, this is a non-recourse loan. How much ever money you get from the home, that you can take it. Well, if you get $10,000 from the home by selling the home, prices would have increased. Recover your 9,000 back and throw that 1,000 on the face of that home loan borrower, correct, on XYZ. But in case if it is a non-recourse loan, but in case if you are able to sell only for $8,000 or for $7,000, then that $1,000, $2,000 is the loss that you will have to take because it is a non-recourse loan. Now this is what happened in the US during the subprime crisis. Okay, again a very hypothetical loan that I am going to tell you, hypothetical example that I am going to tell you. You know why I use hypothetical examples? So that it goes into your mind directly. If I don't use hypothetical example and I use very realistic examples, it will not go in your mind. This used to happen with me. Like when I studied, I was knowing at that point of time only, I always used to think extremes. When I think extreme, I know the difference and I know what exactly the difference between two are. If I don't think extreme, I think very much near, then I can never get the answer in my mind. So now I am going to tell you a hypothetical example. A person in US, there is always non-recourse loan. A person XYZ Limited came to Lehman Brothers, or say for example came to a bank, and he took a loan worth $10,000 to purchase a home. So he purchased a home worth $10,000 and this was a non-recourse loan. He paid $500 as EMI. Okay, he paid $500. So now the home loan that is pending on his head is only $9,500, which he will have to pay me over the period of next 7 years. Next 10 years he will have to pay me. Now what has happened, being a non-recourse loan, the value of this home fell down to $1,000. The value of the home loan, the value of the home fell down to only $1,000. So now what am I going to do? XYZ Limited, he came and told, if you want to take back the home, I am not going to pay $9,500 over the next 5 years, over the next 10 years. Okay, he is not going to pay me $9,500 over next 10 years. What will he do? He will take back the keys and take back the home, and you do whatever you want to do with the home. You sell it out for 10, 15, 25, $30,000, whatever you want, you sell that home. He is telling this to bank. Now bank said, okay, if you don't want to pay, get lost, give me the keys and I will sell this home. When the bank actually went in the market and sell this particular home, the home prices had fallen so much during subprime crisis, I could sell only for 1,000. And you know, when I could sell only for 1,000, what happened? I was facing a loss of directly 8,500. This was the loss that the bank was facing. The investor was very happy. He purchased an exactly identical home, next door home, which was worth $1,000. And just see, he was saved from paying $9,500. Actually, he saved $8,500 when the prices fell down. So in US during subprime crisis, the investors were, the home loan borrowers were very happy. They got the home at such a cheap price. The banks, the financial institutions, the investors of securitization process, all of them were very, very sad because they had faced the losses, not the home loan borrowers. The general public, thousands of home loan borrowers who would have taken loan few months back, few years back, they were very happy that prices fell down. This is what subprime crisis is. And who is responsible for that? This non-recourse loan. This non-recourse loan was responsible. If it was a recourse loan, those home loan borrowers would be shivering as to what, they will come to my home and they will harass me, they will harass my kids, they will take this, they will take that from my house, they will take my mobile phone and then recover the money. But over here there was no option left. They could only sell the home. The bank could only sell the home and recover the money. No other option was possible. And this is what your non-recourse loan is. Right? Very simple. Everyone understood what the subprime crisis was. Okay, I hypothetically gave you the example that 10,000 fell down to $1,000. Such a huge reduction did not happen, but this is how you understood, right? So always use hypothetical and you will get the results. Now moving on to the next concept. Now the next concept is mortgage pass-through securities, a concept which is same or maybe similar to your asset-backed securities. Okay, the securities that we saw, mortgage-backed securities, other asset-backed securities and so on. It's similar to that, only it is named as mortgage pass-through security. So what happens over here is, say for example, this is your SPV. Okay, SPV has given out loans, say for example to buy a home, so home loans. So these are residential mortgage-backed securities. Now there are different investors to whom securities have been issued. The securities that has been issued are called as mortgage pass-through securities. Why? Because their work itself is to pass on the equated monthly installments or the level payments, fully amortizing level payments from the loan borrowers to the investors. Whatever the money comes from here, it is going over there. Whatever the money comes from here, it goes over there. From whom? From loan borrowers. Every month whatever the money comes, it goes to the investors. And therefore, these securities are known as mortgage pass-through security. Mortgage because these are residential mortgage backed securities, like these are residential properties and therefore mortgage. pass through securities. Why pass through? Because it is going to pass on all the monthly installments that are coming from the home loan borrowers, and therefore they are known as mortgage pass through security. So these securities facilitate passing on all the EMI collections from the borrowers to the investors. So it comes from borrowers to the investors. Now there are two important concepts over here: weighted average coupon and weighted average maturity. What do we mean by both of them? Okay, now listen very carefully. What happens that in the month of October, HDFC Limited gave out loans to so many people in the market. Okay, say for example, one person was given $1 million loan for 10 years at 10% per annum interest rate. Another person was given $2 million loan for 20 years at 8% per annum. Other person would be given $1.5 million loan for 15 years at 7% per annum. So everyone would be given based on the borrower's risk and whatever the credit rating credit would have been done, and whatever the underwriting the norms would be of the bank and so on, based on the risk profile of the borrower. Accordingly, the rate and tenure would have been decided, whatever the property is, where the property is. Accordingly, this is the rate and this is the years for which the loan has been given, and even the loan amount is different. Now what happens is, in all total $100 million worth of loans have been given. So what happens is, the mortgage pass through security that are given over here to different investors, okay, $1,000 is the par value of one particular bond of this particular security. So likewise there would be how many? 1,000, 10,000, 100,000, million, 10 million, 100 million, right? So these many. So 100,000 bonds of 1,000 each, 100,000 bonds, okay, 10,000 bonds of $1,000 each have been given out in the market, right? Correct. So now what is happening is, these guys are given a weighted average coupon and weighted average maturity. In future these bonds will have to be redeemed completely, right? They also need to be given some coupon interest, otherwise why will the investors invest in this particular SPV, in this particular bonds, in this particular securities? The investors are going to invest in this particular security for a coupon, and they will also be given a maturity, that the bonds will get redeemed at this particular date. Now this is what we are trying to understand as to what the rate will be, that is the coupon will be, what are these people going to get the coupon, and what will be the maturity of these particular bonds so that it gets redeemed, and therefore this is what we are going to calculate. Now remember, the home loans that we get over here, the home loans that have been given, this is $1 million, $2 million, $1.5 million and so on, for number of years which are over here, and for the rate, everyone is given a different rate. Remember guys, whatever is going to come from here, this side, whatever that is going to come from here, everything needs to be passed on from SPV, because this is a mortgage pass through security, and from here it is going to go to the investors. Nothing is to be kept with SPV apart from some minor service fee and service charges which it will be giving back to the originator or HDFC Bank Limited. Okay. So apart from that, everything, technically the whole portion, the whole amount that comes from home loan borrowers needs to go to the investors, right? And that's why the name is mortgage pass through security. So what should be the rate, the coupon rate, and what should be the maturity date wherein all the money will pass on from here to here? This is the weighted average coupon and weighted average maturity. So everyone are given 10%, 8%, 7% differently. Based on that we will be calculating the weight. So out of 100 million, this forms a weight of 0.01, this forms a weight of 0.02, out of 100 million, 1.5 million forms a weight of 0.015. Correct? This is what is happening. Correct? So these are the weights. Now this weight multiplied by the number of years will give me the weighted average like 0.01 into 10 is 0.1 year, and so on when 0.02 into 20 years. So, this is 0.4. Likewise, when you do for all, say for example, you come to 13 years as the weighted average maturity. Maturity multiplied by the weights. Weights have come from this amount of loan that we have given, okay, the loan for the buying the home. So, that weight multiplied by number of years, that is 0.1, it comes to 13 years when you add all of them. This weight multiplied by the rate, so 0.01 into 10 comes to 0.1 percentage, 0.02 into 8 comes to 0.16 percentage, and so on. When you do it for all of them, you come to, say for example, 9.3 percentage, right. So, this 13 years and 9.3 percentage is the weighted average maturity and weighted average coupon. This weighted average maturity and weighted average coupon is nothing but the maturity date and the coupon for these securities. So, even though SPV is getting different rates, different maturity from all of these home loan borrowers, but when you take a weighted average of all of these, you are going to issue security to the investors at weighted average maturity and weighted average coupon. So, these securities will be 13 year 9.3% amortizing bonds, correct. This is how you will be writing, these are amortizing bonds, and this is what your mortgage pass through securities are. In mortgage pass through securities, remember, you are going to get weighted average coupon and weighted average maturity, correct. We will move to the next concept, very important, looking at the prepayments. What are prepayments and how does it result into prepayment risk? Prepayment risks are of two types, extension risk and contraction risk. So, if I say prepayment risk, in your mind both the things can come up, that this can either be extension risk or this can be contraction risk. It can be anything if I use the word prepayment risk. So, prepayment risk is anything, extension or contraction. But what exactly is prepayment risk? Let us see. For that we will have to learn what the prepayments are, okay. Understand this particular example very well. We have seen that on a total basis, the weighted average maturity comes to 13 years and the weighted average coupon comes to 9.3%. It is the weighted average of all these home loan borrowers. The weighted average comes to 13 years of maturity, 9.3 years or 9.3% of weighted average coupon, which is what we are going to give to the mortgage pass through securities and technically to the investors. Now, what we are going to look over here, just see what is prepayment and therefore what is prepayment risk. Let me come back over here only. Say for example, it so happens that these home loan borrowers, they are given an opportunity, they are given the right to anytime come up and give extra money, okay. They may give up extra money in the sense, say for example, prepayments. Prepayments are what? If at all the home loan borrowers are having extra money with them, say for example, they got a salary hike, they got a bonus during Diwali, during Christmas, or whenever the bonus cycle is, they get bonus from their offices, from their workplace, they got they inherited a huge amount of property from their spouses, grandparents or parents, okay. Yeah, it's very good to get something, inheritance from your spouse's parents, right. So, yeah, so you inherited something, you got your name in a lucky draw and you got a lot of money, you went to a casino and you earned a lot of money, whatever, somehow you got a lot of money, okay. Now, if you are having a lot of money, then technically you will definitely, like a normal person, a rational person will definitely go and pay back some amount of his loan that he is having on his head. If I am having a loan on my head, I will definitely try to just remove that loan. Like Indians, they don't like to have loans on their head, okay. If they are having a loan, they would try to just be debt free. Some of the Western countries, they live only on the loans. Okay, they spend by their credit cards completely. The credit cards are also being paid based on that month's salary, not from the savings that they would be having. Savings are also less, they don't keep cash with them. This is the tendency of the Western world. For India and similar cultured companies, there is more of savings. People would like to save, not like to have their loans. They would also not like to have home loans, rather they would like to purchase the property on their own. Whereas if you go to the West, you will see, in spite of being so much rich, they will definitely buy the home on a loan basis, on a mortgage basis. Okay, so this is the difference, but no doubt. Okay, that's why it is very big component, like mortgage pass-through securities, asset-backed securities, mortgage-backed securities. It is a huge component, a huge market in the Western world, in US, Canada, UK and all of these countries. In India it is a little bit less because people have their own homes. Okay, so they own them. Okay, but what our contention over here is, we are looking at what the prepayments are. So if, say for example, home loan borrowers are having excess money with them, okay, then rather than investing somewhere in bank at 5%, 7%, they would like to erode off their loans. They would not like to keep loans, because loans are at what, 9.3%. Say for example, this person's loan is at 10%, and if the fixed deposit or term deposit rate in the bank is just 6%, then why will he put that extra money in 6% in the bank? Rather he would just take off his loan worth 10%, right? And that will be profitable for him. And therefore that guy, if his EMI comes to $1,000 every month, okay, that month's EMI is $1,000, yet he will repay off whatever the extra money is having. Say for example, he is having $25,000 that he has earned, or got a bonus, or he got a lottery or something. Somehow he got that $25,000. Okay, so that month, apart from paying $1,000, he will also pay back $25,000 more additional amount. Why? Because he has got extra money and he don't want to keep that extra money in the bank. He is going to do prepayment. Okay, the payment was not due, yet he is going to do prepayment. Correct? Now just hypothetically think, everyone, all these hundreds of borrowers, those who have taken the money, all of them are doing a prepayment. All of them are doing a prepayment. So now what happens is, they are going to pay $25,000 each. Now just imagine $100 million, and that too they are doing every month. Just consider, every month everyone is doing a $25,000 prepayment. Okay, it is hypothetical example. So what it will happen is, within 1 year all of these 13,000 will get completed, right? In short, I am trying to say that if people prepay, okay, if people, these home loan borrowers are prepaying the amount, instead of 1,000 they are paying back $25,000 every month, then instead of 13 years for this loan to get completed, now it will just take 10 years, just as an example, it will just take 10 years, right? This is what we are talking about. This is what we are talking about. Now I have given bonds to them for 13 years, and therefore what is going to happen is, it is now going to actually take only 10 years. And therefore Hdfc Bank Limited, who is setting up the SPV, and at Hdfc Bank some person would be calculating all of these, that some person who is calculating all of these, like who all are the borrowers over here, some person would be thinking at Hdfc Bank Limited, when on 1st November they gave out this security, so what would be the characteristics of this security, what should be the weighted average maturity, what should be the weighted average coupon, that one person, a CFA, maybe they have employed, Hdfc Bank Limited has employed a person, a financial analyst who is calculating all of that in their organization. So I came up with 13 years is the weighted average maturity. But I also came to know that these people are going to prepay some or the other amount. Okay, I forecasted in my mind that these home loan borrowers are all very rich guys, they are all very successful in their life, at the workplace they are going to get good bonuses, and therefore what is going to happen is all are going to pay me prepayments. And therefore I know in my mind that even though on a normal basis the weighted average maturity is coming to 13 years over here, yet on my forecasted mind I am forecasting that actually in reality, like in reality whatever can happen, that by my forecast and by my analysis I think that people will be giving me prepayments, and this particular loan in 10 years is going to get completed. This loan in 10 years is going to get completed. All the people over here, even though the on a weighted average basis 13 years is coming out, but people are going to prepay to me and they are going to complete the loan in 10 years only. And therefore what I smartly do is that instead of giving these loan at 13 year, I am going to give this securities at 10 years only. Correct? What am I doing? I am forecasting. I am forecasting that by how much time these, even though weighted average maturity has come out to 13 years on the calculator, but then I am further forecasting at what rate these people are going to do the prepayments to the SPV, and therefore within how much time they are going to really give back the amount. So that is the forecast. If I forecast, I may come to 10 years. If I tell you to sit down and forecast, you may come with 9.5 years. If I tell a third person to come and sit down and calculate and forecast, then he may come up with 11 years. So everyone, it is very subjective in nature, because here forecast is required, and therefore as per me, my forecast says that within 10 years they are going to prepay the whole amount, and therefore I am not going to give this mortgage pass through security at a 13-year maturity. I am going to give them at 10-year maturity. This mortgage pass through security is going to be at a 10-year maturity. The bonds that I give, the mortgage pass through securities that are given to the investors will be at a 10-year maturity because of the forecast. Why? And why did I do the forecast? Because I was knowing that definitely people over here are going to do prepayments, and in reality also prepayments happen. Now how much it happens we don't know. That when time comes only we will come to know. But prepayments do happen is for sure. How much is what we don't know, and that is where forecast is required. That is why educated people like us are sitting over here and forecasting as to what will be the prepayments, what is the economy going to be. If the economy is going to be very robust and it is going to move ahead like anything, no one will be losing jobs over here, everyone will be doing very well at the organization where they are working, people will be getting hefty salary and hefty bonuses, and all of this is a forecast that I need to do. And if I know that these people are going to get so much of bonuses and these are very good guys, and all the assessment that I would have done, based on that I will be saying that okay, this much will be the prepayments in future, and therefore instead of 13 years, maybe only in 10 years the loan is going to get completed over here on an average basis. Okay, and therefore I will be giving at a 10 years. This is what prepayment does. Prepayments is going to compulsorily make me think and reduce from 13 years to something else, maybe 10 years. Now coming to a fact. Okay, again this is a very shabby slide that I have made, but I am hoping that you all are understanding it very well. Very important concept. Okay, very important concept. So understand it very well. Now what is prepayment risk? Now there is a risk. I have made a forecast over here. From 13 years to 10 years is the forecast that I have made, and therefore here comes the risk. The risk is that I would have made a wrong forecast. Okay, obviously how will I know in future what is going to happen? Am I God? Okay, am I God? If I am a God, if I am Arihant, then I can know what it is. Okay, what is going to happen in future, but I am not God, right? And therefore I cannot forecast it correctly. In reality it may so happen, very hypothetical example again, okay, extremely hypothetical, this is not going to happen ever, but just think in a very hypothetical case. Okay, very hypothetical case. Say for example, just in 1 year, okay, since 1 year, like 1 year has passed since this particular SPV has been created and mortgage pass-through securities are given away to these investors. Just in 1 year, one fine day, okay, what happened? Everyone, all these home loan borrowers, okay, all of them, okay, very hypothetical, all of them got a huge lottery, and a few of them also got inherited a lot of money from their ancestors and from their parents, grandparents, spouses, parents, grandparents, whatever, and now all of them are very rich, all of them, okay, not even a single person is left out, and now all of them are thinking to just buy away the property from us, like just giving away all the loan amount, whatever the EMI are there, so that for the next 12 years they don't have to now remain, you know, they don't have that the tension and that headache in their mind of paying back the amount. So what did they do? All of them over here, home loan borrowers, they paid back the full amount to me, to the SPV, and obviously the SPV will have to give away everything to the investors, okay, because SPV is not, they are just going to pass on. So these home loan borrowers, as soon as the 1 year ended, they gave away the whole amount, okay, all out of 100 million. In the first year, around 6 million was paid off, 94 million was still remaining to be paid off over the period of 12 years. 1 year completed and they gave away all $94 million. Whatever was pending, everything was given away to the SPV, and SPV gave away to the investors. Now investors were in tension, right? Investors were in tension. All 94 million came back and this SPV got now closed. This SPV now got closed because now there is no use of SPV, right? Whatever the money was required, everything came back and investors were given, close the SPV. Now it is done, correct? Now there is no use of that. Now what happens is, over here the investors have faced a risk. Just see, they were thinking, see now why is there always a risk? Even if you are getting some money early, there is a risk. Like in business, if someone doesn't pay money, I will be taking some tension or load on my head. But if someone pays me early, I will be very happy. But over here in investment purpose, okay, just remember, anything that happens which is not planned is a risk. If you get money late, that is a risk, obviously. If you don't get money or you get money very little late, you will be just pressurized as to whether that person will give me money or not, as he got bankrupt or not, okay, all of this you will be thinking. So getting money late anyways, we know that it is a risk, okay, all of you also know. But remember from me right now that in finance, even if you get money early, that is also a risk. Why it is a risk, that I will explain you in some time, okay. Whatever that you have planned, if it doesn't happen as per the plan, then it is a risk. Over here we had planned that in 10 years this money is going to be received back, but actually we are receiving the money just in 1 year, as soon as 1 year got ended and all the money came back, and therefore this is a risk. This risk is known as contraction risk, because these guys, okay, now you forget what the 13 years was, I had given them 10 years as the maturity date. This is the 10 years maturity date that I have given them. 13 years is something that you need to now forget it out, okay. 10 years is what I had said, but in reality only in 1 year all the money came back to them. So now this is the contraction risk, because their maturity date has contracted. It has contracted from 10 years to just 1 year. The risk that these guys are facing is contraction risk, okay. Now what is extension risk? Say for example, I had expected or I had forecasted that in 10 years I will be getting back all the money, right. Ideally, if everyone pays very sincerely exactly the EMI amount, whatever the EMI amount is, only $1,000 every month they pay, they are not having this excess $25,000, okay. Exactly, very hypothetical, each and every home loan borrower pays exactly the EMI amount that they have to pay, not even a single penny more, not even a single penny less, correct. Then what is going to happen? It will take exactly 13 years, right. What was originally coming out of the weighted average maturity, over here it will take 13 years instead of 10 years that I had forecasted. I was thinking as if people will be giving $25,000 extra whenever they get bonuses and all, but they did not do all of that, right. They did not do all of that in reality, okay. In reality they did not do like that, and therefore now it will be taking exactly 13 years, but I have given them mortgage pass through security whose maturity is 10 years only. but in reality in 10 years they are not going to get back money. It will take exactly 13 years now, and this is therefore known as extension risk, because in reality now instead of 10 years now it will be taking 13 years. I have actually not made a mistake in my forecasting. Okay, that is forecasting. Obviously the forecast only means that it may get wrong results later on, because in reality something else is going to happen. That only means it is a forecast and it is not a fact. That is why it is known as a forecast. Otherwise I would have said that this is what is finally going to happen, it's a fact. But I am not God, right? If I was God I would have forecasted very well, either 1 year or 13 years exactly. But I had to come to a conclusion of 10 years, which is the forecast that I made. Now what the forecast I have made, in comparison to that there may be either prepayment risk, which is a extension risk, or it can be a further contraction risk. This is known as the prepayment risk. Remember, prepayment risk doesn't always mean it is a contraction risk. When people are prepaying, that doesn't mean it will lead to contraction risk only. It may lead to extension risk. If there are more prepayments, I had expected 25,000 extra dollars will come every month, or maybe every year from these people, okay, and accordingly it will just take 10 years. Now if as an example, instead of 25,000, $28,000 is coming every year, okay, from these people as an average, then instead of 10 years now it will take only 9.5 years. This is what is the contraction. Or else instead of $25,000 which I had expected, only 20,000 comes. People are prepaying, no doubt they are prepaying, but they are prepaying less than what I had forecasted, and therefore now instead of 10 years maybe it will take 10.5 or 11 years, not 13 years. Okay, if they don't pay anything then it would become 13 years, but they are paying, they are prepaying, but they are prepaying only 20,000. I had forecasted 25,000, but they are prepaying but only 20,000, and therefore this will lead to extension risk. Now it will take, instead of 10 years it will take 10.5 or 11 years. This is what your prepayment risk is. So prepayment risk, extension and contraction risk, in both the cases prepayments would happen, but in one case prepayments will happen less than what was forecasted, which is contraction risk, less than what was forecasted, which is extension risk, and if prepayments happen more than what was forecasted, then that will be contraction risk. Understood? Everyone understood what extension and contraction risk is? This is what your extension and contraction risk is. Remember guys, extension and contraction risk is very, very important. Understand the concept. If you have not understood the concept, there is no harm in just replaying back again. Go behind, replay the video and just understand what is extension and contraction risk. When I speak prepayment risk, it means both of them, extension and contraction risk. If I speak contraction risk, then it is subjective to that particular piece. But if I speak about prepayment risk, then just don't consider contraction risk in your mind. Prepayment risk means both extension and contraction risk. Correct? Okay. Now let us come to a point as to, okay, let me first come to a point as to how or when or in which all situations extension or contraction risk may arise. Okay, let me give you a very small example. Why would a person come up with prepayments? Okay, and then the most important thing that I will be explaining you is what is the impact of the market interest rates on these extension and contraction risk. Who faces extension and contraction risk? Okay, in short, who faces prepayment risk? It is the investors who are facing prepayment risk. These home loan borrowers are mad. They have their own this thing. They can anytime come and prepay. If they want, they may not prepay. If they want, they may prepay a little bit more. They can prepay little bit less. So they are at their own whims and fancies. Okay, so we are not talking about these guys. Okay, we are talking about these investors. Now these investors, how or who they are going to face the prepayment risk? Okay, prepayment risk means extension and contraction risk. These investors are going to face the prepayment risk, and this is what we are going to now learn as to how the interest rates are going to impact the prepayments. and we know prepayments are actually is having an impact on the investors. Prepayments leads to prepayment risk. That prepayment risk is of two types, which is extension and contraction risk. So what is the impact of the interest rates on the prepayments? How do market interest rates influence these home loan borrowers to either prepay or not to prepay? Okay. I gave you small examples as to how lotteries, how bonuses, how inheritance of lot of money, that gives an impact on these home loan borrowers. Okay. But I didn't tell you how market interest rate also influence these home loan borrowers. That is an important thing. Okay. Otherwise, we know if I have a lot of bonus coming this year, I will prepay a lot of amount of my home loan. This is what we know. It's very simple to think. If I inherit a lot of money from my spouse's father, then or he gifts me something, then I will be very happy. I will just pay off all my home loans. Correct? So that's very simple. And it's very good to think as well. If my spouse's father gifts me something, okay, extravagant, wow, this is an amazing thing. I'll like my spouse a little bit more. Just on a lighter note, okay. Anyways, we'll be liking our spouses whether their parents gift us or not. The relationship is a pure one. It is not dependent or contingent on what gifts her father or spouse's father gives. So this is just on a lighter note. Okay, anyways. So we know if there is huge bonus that these guys get, then they will be prepaying. Now what is the impact of market interest rates on the prepayments and thus on the prepayment risk, which is nothing but extension and contraction risk. So let us see what the market interest rates are. Over here we have seen that, again hypothetical example, okay, very hypothetical. Over here we have seen that the loans, home loans are given to people at 10%, 8%, 7% and so on. So just on an average, okay, weighted average is 9.3%. So we will use that only, okay. Loans have been given to people at 9.3% on an average, okay, on an average. So the SPV is earning money at 9.3% on $100 million, okay. Now at 9.3% the loan has been given to home loan borrowers. However, if say for example market interest rates have fallen down to just 2%, if in case now these home loan borrowers go and take some loan from a bank right now, okay, then they will get loan only at 2%. You know what will people do? These home loan borrowers, they will go to another bank, they will get themselves refinanced. This loan will get refinanced. Now what does refinanced mean? They will go to that other bank, they will say that I want a loan on this particular home, please give me money. So what are they going to do? At 2% per annum, okay, that very low interest rate, at 2% per annum, they will take a new loan from the market because the market interest rates have fallen down to 2%. They will take that new loan, okay, whatever is pending, all of them, all of these people, they are going to take a new loan from the people, okay, and therefore what are they going to do? 1 year has already passed by, okay. At year 1, they will take a new loan. 6 million is already given to us. Now 94 million worth of loans, all of these guys will take from the market at 2% per annum, take that money and throw on the face of this SPV, and that SPV is not going to do anything, okay. SPV only has the work to just give away everything to the investors. What will investors do? Investor will have to take back that money, correct, and this is what the contraction risk is. So when the market interest rates have fallen down, prepayments have increased. They took the loan from outside and they prepaid the whole amount to the SPV, and then the SPV gave away everything to the investors, and now the investors are having the money in their hand, all the money, and then with a crying face they will have to go to the bank and keep the money in the bank. In the bank they will not get more than 2% now because the interest rates have only fallen down. Till now they were getting 9.3%. And now see what has happened. Suddenly by getting extra money, okay, contraction risk from 12 years now 13 years or 10 years, whatever was decided, it has, the whole loan got completed in 1 year only. Their investments came back in 1 year only. Till now they were earning 9.3% for 1 year, and now with the same money they will have to go to bank and invest at just 2%. This is what is the contraction risk, and that is why I told you that getting extra money, the money which was not planned, getting the money early, that is also not good, because now they will have to invest. Till now they had been invested at 9.3%. They were feeling very happy, they would have felt very happy if these guys wouldn't have given back loans to, they would have not repaid back or prepaid back the whole amount. But see, this is what happened, and therefore we conclude that when the market interest rates have fallen down, prepayments are going to increase, and increased prepayments are going to lead to contraction risk. Coming to the other part, market interest rates have risen from 9.3% right now, okay, the average rate at which the loan has been given to these guys, the market interest rates have now increased to 20%. Very hypothetical, I do not know which country would have 20%, at least none of the countries that I know have 20% right now, but just hypothetical, we are just thinking, okay, the knowledge should go in your brains is what we are trying to do right now. So very hypothetically, 20% is the market interest rate. If the market interest rate is 20%, you know what happened? I, as a CFA who was sitting at the organization at SPV, okay, I had come to a conclusion that okay, 10 years is what will be the maturity. Okay, why? Because people are going to give 25,000 of their bonus that they are getting, they are going to prepay that, and therefore I reduced from 13 years to 10 years because I forecasted that $25,000 will be given by them excess, okay, whatever. You know what is happening? No one is giving me extra money when they are getting bonuses. Why? Because why will they reduce their loan which is currently going on at 9.3%? Why will they reduce their loan? Instead, whatever the $25,000 that they have got as a bonus, they will go in the market and keep it at 20%. The market interest rate is 20% right now. They will keep it out over there in the market because they are earning 20% over there, and they will not pay even a single penny more to me over here, to the SPV. Why will they not pay? Because this loan is currently going on at 9.3% only. Why will they pay extra money and thus just reduce their loan which is currently going on at 9.3%? Rather, even if a single penny is received extra from them, they will be putting out in the market at 20%. And therefore, we say that when the market interest rates have risen, they are not going to prepay anything, and therefore there is going to be extension risk to these investors. Extension risk, instead of 10 years, now it will take exactly 13 years for the loan to get completed. Correct? So this is the impact if the market interest rates have fallen. So don't directly think whether it will be extension or contraction. First think whether there will be more prepayments or less prepayments. So if the market interest rates have fallen, there will be more prepayments, and more prepayments leads to contraction risk. If the market interest rate have risen, there will be less prepayments, and therefore there will be extension risk. Okay, so this is how you will have to think. Don't directly jump from market interest rates goes up or down and therefore there will be contraction or extension risk. You will get confused. So in between, first you think what impact will it have on prepayments, and then therefore what impact will it have on the prepayment risk. This is what we are thinking. I hope you all have understood the things very, very well. Okay, very important. Still the importance continues till the time we go ahead, because this whole chapter is important. So I don't need to repeat again and again when I go to next slide that okay, even that slide is important, even this slide is important. The whole chapter is important. Okay, the whole chapter is important. So just focus to what I am speaking. Well, next coming to PSA and CPR. Okay, now just think as to how did I forecast that instead of 13 years it will take 10 years only? How did I forecast what these all home loan borrowers that I had put down over here, all of these home loan borrowers, how are they going to pay me? How did I calculate that okay, they will pay me $25,000 every year out of their bonuses? How did I calculate? So this is how I calculated. Now in the US there was this association called as PSA, Public Securities Association. This Public Security Association, PSA, they had done a study, they had done a survey as to how in US people used to prepay. Okay, just from historic trends and what the economy is and so on, they concluded that the prepayments are going to be in this particular fashion or in this particular manner. So, what is that? So, first understand that the rate at which the prepayments happen, that is known as CPR, conditional prepayment rate. What is it known as? Conditional prepayment rate. Okay. Now, what is it? PSA, that is Public Securities Association, came up with something known as CPR, which is conditional prepayment rate. It is the rate at which prepayment is happening, the rate at which the prepayments will happen, okay, on a monthly basis. So, this is how the CPR is. So, that association, the results of the survey was that every month prepayments are going to be 0.2%. 0.2% of the opening balance or opening monthly balance of the balance that is there, opening balance of the loan that is remaining. Okay. Say for example, first year has got completed, out of 100 million, $6 million has already been come, has come. Okay. Now, $94 million is the opening balance of that particular month. Now, if it is the 1 year has passed, if it is the 13th month, then accordingly whatever is the rate, 94 million multiplied by that 13th month rate, whatever it is. We will see what 13th month rate is. Okay. So, if I tell you like that, then that is the prepayment that is happening. So, the rate is 0.2%. Okay. That is the conditional prepayment rate. Fine. So, now PSA came out with the results that in the first month the prepayment will be 0.2%. In the second month the prepayment will be 2 multiplied by 0.2%, so it comes to 0.4%. In the third year the prepayments will be 3 multiplied by 0.2%, which is 0.6%, and therefore it keeps on adding that 0.2%. So, whatever the month is, multiply by 0.2 you do and you get the amount. If I come to 10th month, then 10 multiply by 0.2%, which comes to 2%. If I come to 15th month, it will be 15 multiply by 0.2%, which is 3%. If I come to 25th month, it will be 25 multiply by 0.2, which is 5%. Just listen more, okay, the twist will come, do not get bored. When I come to 29th month, it will be 29 into 0.2, which is 5.8%. 30th month, it will be 30 multiplied by 0.2, prepayment will happen, but it will happen at 6% per annum. In the 31st month, prepayments will happen, but the rate will be same 6% only, which means that now there is no increase in the rate of prepayment. Okay, there is no increase in the rate of prepayment. Yes, prepayments are happening, but they are happening at what rate? At 6% CPR. At what rate? At 6% CPR. In the 35th month also what? Same 6% only. There is no brainer. It has stopped. Till 30th month, yes, you were doing whatever the month is, multiply by 0.2. Whatever the month is, multiply by 0.2, and that is what your CPR was. As soon as you passed 30th month, then the CPR is constant, which is 6% only. This was the result of the survey that was done by PSA. Public Securities Association made a survey, and this was the result of the survey, that this is how the prepayments are going to happen. If I do not have brains, then I will directly take what the PSA has given. Okay, I do not want to find out what the CPR will be for my particular this particular SPV, and therefore I will take whatever the PSA has given in the results of the survey. This is the result of the survey, and therefore this is known as 100 PSA. What is this called? This is called as 100 PSA. What do you mean by 100 PSA? PSA of 100. 100 PSA means 100% of what they have thought. Okay, no plus or minus anything, no 75% of what they have thought, no 125% of what they have thought, nothing. 100 PSA means exactly this particular thing. But what happens in reality is, this is the survey that the PSA has done. Now this guy over here is over smart, he is very smart, rather I would not say over smart, okay. Why am I unnecessarily degrading myself, okay. I am smart, okay. Now I am very smart, I am hard working. You know what did I do? I started analyzing, reviewing and taking an assessment of all of these home loan borrowers that I was having, okay. I am very hardworking. I took the credit files of each and every person, the home loan borrowers, and I checked all their documents, all their papers, who the people are, you know, what their mentality is, everything, all X, Y, Z things I did. And then I understood that, okay, these guys are actually very rich guys, these guys are doing very good in their life, these guys are working in some gigantic tech companies like Google, Amazon, Facebook, whatever. These guys are doing very well at their organization, these guys are constantly getting good bonuses every year. Some of them are very rich guys, their spouses, parents are also very rich, they will be getting inheriting, they are also very old, and therefore once they expire they will be leaving all their property and everything to these guys, you know, all of that. I did all of that assessment, okay, all the XYZ assessment, I do not want to say more. I did all the assessment and then came to a conclusion that these people are going to pay me more prepayments. No doubt, PSA has come up with this prepayment schedule, PSA has come up with this particular schedule, but in reality these people will be paying even more than what this schedule has been given by the PSA, and therefore I will be coming to a conclusion, or I will be forecasting that in reality the prepayments will not be 100 PSA, but the prepayments are going to be 100, it is going to be 200 PSA. 200 PSA means double of what this has been given. 200 PSA means what? Double of what these guys have given us, correct. PSA has given this as the schedule, that prepayments will happen and it will happen at this rate. If I do not want to think anything, I am a lazy guy, I do not do anything, I will directly take what 100 PSA is. But now I did so much of assessment and I saw what these people are going to pay me as a prepayment. I want to correctly come to a conclusion that it is not 13 years, it is 10 years. Like PSA would have given from 13 years to 10 years. Now I will think how well or how much these people are going to prepay me, and therefore then I will do on my own the assessment, and I came to a conclusion that prepayments are going to be significantly more than what the schedule has been over here, and therefore I will say it will be 200 PSA. 200 PSA means 200% of the PSA. Over here it means 100% of what they have said. Over here it means 200% of what they have said, which means it is 2 times of this. So this is 100 PSA, 200 PSA will be 2 times of this. So everywhere you will have to do multiply by 2, multiply by 2. So it comes to 6. In the 30th month it will be multiply by 2. 200 PSA of 30th month means what? First imagine what the 100th month PSA, 30th month 100 PSA is. 30th month 100 PSA is 6% we know. But then what is 200 PSA? Just multiply that by 2 and you get 12%. Then it will remain the same 12%, 12%, 12%, whatever it is. This is how we do. If it was 75 PSA, then I would multiply everything with 0.75 and come with an answer. I would come with multiply by 0.75 if it was 75 PSA, correct. This is how the assessment is done by me. I will see whether 100 PSA is the survey that they had done. Do they know what my SPV is and what my type of home loan borrowers are? That survey has not been done. That I, who is sitting over here on 1st November, I am at Hdfc Bank, I am going to analyze what these people are, they are, I am going to assess them, and therefore I will come to a conclusion as to whether they are at 100 PSA or they are at 125 PSA, 200 PSA, 75 PSA, whatever it is, X, Y, Z. This is what your PSA concept is. Everyone understood what it is? Okay. Now we will do a certain example, okay, a certain example, okay. If I tell you what is the 18th month 100 PSA, okay, this is the month and this is the PSA. Okay, PSA. This is the month and this is the PSA. Come on, what will be the percentage rate, the CPR, what it will be? Come on, tell me. So 18th month 100 PSA is 18 multiplied by 0.2, which comes to 3.6 months. It comes to 3.6 percentage, okay, not months, 3.6 percentage. This is the conditional prepayment rate. This is the rate at which the prepayments are going to happen. Now tell me, what is the 34th month 100 PSA? 34th month 100 PSA, it will stop at 30 into 0.2, which comes to 6 percentage. Okay. Now tell me, what will be the 13th month 120 PSA? 13th month 100 PSA. I hope you all are pausing, first doing on your own and then seeing what I am doing, right? So pause whenever I just complete writing this. Okay. So 13th month into 0.2 into 1.2, which will be 2.6 into 1.2 comes to 3.12 percentage. What will be the 7th month 60 PSA? Well, 7th month 100 PSA is this, but we are talking about 60 PSA, so it will be 1.4 into 0.6 comes to 0.84% is the rate, correct. Now what is the 39th 180 PSA? This is 30th month, we will stop, we are not going to move ahead. Multiply by 0.2 is for 100 PSA, multiply by 1.8, which comes to 6 into 1.8 is equal to 10.8 percentage, correct. So this is what your CPR is going to be. I hope you all have understood what the 100 PSA means, what the 200 PSA means and so on. Shall we move ahead? Now tell me one thing, we have already done this, what will be the impact on prepayments and accordingly what risk the investors would be facing? You need to tell me this particular thing. I will come up with the answer, I will explain you, but first I want you all to think. If the prevailing market mortgage rate has fallen down or it is very low, prevailing market mortgage rates in the market, they have fallen down, then what impact will it have on prepayments? Will the prepayments will be more or will be less, and accordingly what will be the risk? Will it be contraction risk or extension risk is what the answer I want. Okay. So this is what I want from you all. Okay, this is what I want from you all again. Okay. If the housing turnover is more, housing turnover means one person is selling the house, buying a bigger house maybe, or going for a smaller house, whatever, selling that house and again taking a new house, selling that house and again buying a new house, and you know that housing turnover is low, moving from one country to one city to another city, so obviously he will have to sell this house, right. So if this particular thing happens, then if the housing turnover is more, then this is what I am asking over here. If the unemployment rates are very high, unfortunate event, but if the unemployment rates are very high, then what impact will it have on prepayments and associated risk? If the economy is doing very good, okay, people are having lots of good employment and you know economy is doing good in short, okay, then what it will be? And if the loans are very young, the portfolio of loans that the SPV is having, the home loan borrowers, okay, if the loans are young loans, okay, the loans are young loans, then what impact will it have? I will explain you what it is, but first if you know, then write down the answer. Prevailing market interest rates. What are the prevailing market interest rates? So the answer is this. Well, I will explain. I want to know who got all of them right, okay, all of them right. Connect with me on social media, Instagram, Facebook, YouTube, everywhere. On Instagram, you can DM me and tell me that I got all the 5 these 5 and these 5, all the 10 things correct. If all of them are correct, then you connect with me on Instagram, personal message to me on Instagram, okay. So personal message to me and I'll connect with you. Through Facebook also you can message me, like my page, and you can leave a comment over there. YouTube again, you can like and comment me over there on the YouTube. Well, now what does it mean? Prevailing market mortgage rate. If the market interest rates have fallen down, then people will take loan from that market guy and prepay me the whole amount. So the prepayments will be more. If the prepayments are more, it will lead to contraction risk. Housing turnover. There is a lot of housing turnover. People sell this property, the existing property that they have, and they buy the new one. They sell that property, buy a new one. So when they are selling the existing property and buying a new one, no doubt they take a loan against the new property, but this loan is then paid off, right? This loan is then paid off, and therefore when they pay off that loan, the prepayments are going to be high because they are paying off that loan, and therefore it leads to a contraction risk. Unemployment. There is a lot of unemployment in the market. People don't have jobs only. They can barely pay the $1,000 EMI that they have to pay. Forget about taking another 25,000 prepayments that we were thinking about, because people don't have job only. From where will they bring even $1,000? Yet they are trying to give $1,000. This is what it is. So if the unemployment is high, no prepayments are going to come. People are barely paying $1,000. Forget about $25,000 extra prepayments that I had thought of. Okay, I had thought, I had forecasted, but now that is not coming. So that will lead to extension risk. Why? Because the prepayments have fallen down. If the economy is doing very good, okay, people are getting more bonuses, people are getting profit linked incentive, sales linked incentive, because economy is doing good, right? So profits of the company will also be good, and all of these things. People will get more bonuses and all of that, and that is going to lead to more prepayments, and accordingly it will lead to contraction risk. Young loans. If the loans are young, which means, just as a very hypothetical example, if I have taken a loan just last month, okay, just last month I took the loan, and the SPV is created just 1 month back, okay, because last month the loan was taken, and SPV was also created last month accordingly, and therefore the securities that are there in the market currently are just 1 month old, because the loans are also just 1 month old. If they are young loans, okay, the loans are young, just 1 month back loan was taken, do you think I will be having so much of money? Like my EMI is 1,000, okay, do you think I will be having so much of money to prepay back all the amounts, all the loan back just in 1 month? Then why will I take loan only? Why will I take a 10-year loan if I want to pay back in 1 year, 1 month only? Will I have so much of money? No. But say for example the loans are old loans, okay, they are not young loans, they are old loans. The loan was actually taken 5 years back, and in 5 years, I have made such a good growth. My salary is literally 25 times right now, and I am doing really very good. The Infinity Concepts is doing very well, and I am earning a lot. I had not thought it was going to be so good, okay, and therefore now what is going to happen? I was thinking that every month I will be paying 100 EMI, but now itself I am earning $1 million every month. Again hypothetical little, okay, no doubt, that is my aim or a goal, but whatever it is, now every month I am earning $1 million. Do you think I am going to keep this housing loan on my head? The home itself was worth $1 million. I paid back and threw all the money on SPV's face. It is just 1 month's earnings that I am having. Earlier, 5 years back when I was very new, for me at that point of time even $1,000 was much. Okay, at that point of time I couldn't even think of paying a single penny more. I was barely living with whatever funds that I was having. But now after 5 years, when the loans are actually old loans, so many people would have, no doubt there will be few people who would not be doing still good in their life, but there will be so many others who would be now doing good in their life. 5 years back $1,000 was too much for me. Today $1,000 is not much for me, because my salary would have also increased in that, in that much time. I would have also have a lot of savings as well. Maybe in 5 years I would have inherited some money or something, some or the other things. So old loans, prepayments are going to be more. Like for me, if I am earning so much, prepayments will definitely be more. I will rather pay back on the first month only. As soon as I get the money, as soon as I start doing good in my workplace, I will prepay the amount. So young loans, prepayments are going to be very less, and therefore they will lead to extension risk. But in case there are too many old loans in there, in the over here, old loans, okay, the loans which were given long back, then obviously as and when time passes, the prepayments will be more, because now for these people, salaries have increased in those 5 years, 7 years, 10 years, whatever old, however the more the old the loans are, the more the salary, the growth would have happened over those many years, and therefore now $1,000 is nothing for them to be paid, and therefore they will pay 10,000 every month rather than 1,000. So that is what the prepayments are. So for old loans, prepayments will be high, therefore that will lead to contraction risk if it is old loan. Young loans will have a lesser prepayments and therefore extension risk. Fine, we will move on. This was an important one. This requires a little bit of thinking in your mind as to what impact will it have on the prepayments. Whatever impact it has on prepayments, we know it will lead to either extension or contraction risk.